The Dow Jones Industrial Average has officially entered correction territory, dropping more than 10% from its recent highs, and the panic on Wall Street is becoming palpable. If you are looking at your portfolio right now and seeing a sea of red, the most important thing you can do is take a deep breath and look at the actual data. A correction is a technical milestone, but for most retail investors, it feels like a crisis. To understand what is happening in March 2026, we have to look at the specific catalysts that pushed us over the edge. The primary driver behind this slide is a perfect storm of macroeconomic pressure and geopolitical instability. Crude oil has spiked to $115 a barrel, and the ongoing conflict in West Asia has created a massive bottleneck in global supply chains. When energy costs rise this sharply, it acts as a hidden tax on every single consumer and corporation in the country. This has forced the Federal Reserve's hand, as inflation prints are coming in much hotter than anticipated. Investors who were betting on aggressive rate cuts this year are now realizing that higher for longer isn't just a slogan, it is the reality of the 2026 economy. But what does correction territory actually mean for your money? By definition, a correction is a decline of at least 10% but less than 20% from a recent peak. While the word correction sounds ominous, these are actually a healthy and necessary part of a long-term bull market. They flush out the excess speculation, lower astronomical price-to-earnings ratios, and provide a reality check for overvalued sectors. In fact, since the mid-20th century, the stock market has averaged a correction roughly once every 2 years. The reason this one feels different is the velocity. We saw the Dow shed thousands of points in a matter of days, triggered by algorithmic trading and a mass exodus from high-growth tech stocks. If you look at the sector heat map right now, the carnage is not evenly distributed. Technology and consumer discretionary stocks are taking the brunt of the damage. These are the growth areas that rely on cheap debt and high future earnings. As interest rates stay elevated to combat the $115 oil price, the valuations of these companies are being re-rated downward. On the flip side, we are seeing a rotation into defensive posture. Energy, utilities, and aerospace and defense are currently the only areas showing any signs of life. This great rotation is a signal that the big institutional money is shifting from offensive growth to capital preservation. The danger here is the psychological trap of the bottom. When the market drops 10%, the instinct is to either sell everything to save what's left, or to throw every cent of your cash into the market thinking it can't go any lower. Both of these are emotional reactions that ignore the technical reality. Historically, corrections can last anywhere from a few weeks to several months. In 2026, the volatility is being amplified by 24-hour news cycles and instant mobile trading, which creates a feedback loop of fear. Right now, the Dow is testing key support levels that have held firm for the last 18 months. If we hold these levels, this correction could be a short-lived blip, by the dip, opportunity of a lifetime. However, if the geopolitical situation escalates further and oil moves toward $130, that 10% correction could quickly transition into a 20% bear market. This is the moment where your strategy is tested. It is where the diamond hands are separated from the panic sellers. Understanding the anatomy of this 10% drop is the first step in making sure you don't become a casualty of the 2026 market shakeup. Keep your eyes on the data, not the headlines, because the next move the Dow makes will define the trend for the rest of the year. While the headlines are focused on the immediate chaos, the real money is made by looking at the historical data. If you want to know where the bottom is in 2026, you have to understand that the stock market doesn't move in a straight line, it moves in cycles of fear and greed. By comparing our current 10% drop to previous market corrections, we can start to build a map of what the next few weeks will actually look like. Historically, a standard market correction lasts an average of about 4 months from the peak to the trough. If we look back at the volatility of 2018 or the high inflation environment of 2022, we see a recurring pattern. The initial 10% drop happens quickly, usually within 2 to 3 weeks, followed by a period of choppy, sideways trading. In 2026, we are seeing a much faster acceleration because of high-frequency trading algorithms that trigger sell orders the moment certain technical levels are breached. This flash volatility can make a standard correction feel like a total collapse, but the recovery timelines often remain remarkably consistent. One of the biggest dangers for investors right now is the dead cat bounce. This is a phenomenon where the market seesaws, jumping up 2 or 3% in a single day, leading everyone to believe the worst is over. In reality, this is often just a temporary pause before the next leg down. To find the true bottom, professional traders look for a retest of the lows. This means the market drops, bounces back slightly, and then falls again to see if buyers will step in at that same low price point. If the Dow can hold the 10% support level a second time, that is a high probability signal that the bleeding has stopped. Another critical tool for your 2026 playbook is the Fear and Greed Index. Right now, this index has slammed into extreme fear territory. While that sounds terrifying, seasoned investors know the old Warren Buffett adage, be greedy when others are fearful. When the index hits these extreme lows, it often indicates that the selling has become exhausted. Most of the people who were going to panic sell have already done so, leaving only the strong hands behind. However, we have to acknowledge the unique pressures of the 2026 landscape. Unlike the corrections of the early 2000s, we are dealing with a sticky inflation environment and a massive geopolitical shift in energy markets. This means the recovery might not be the V-shaped bounce we saw during the pandemic era. Instead, we are likely looking at a U-shaped recovery, a slow, grinding process where the market stabilizes, builds a base, and gradually climbs back as energy prices normalize. The bottom line is that you cannot time the exact bottom to the dollar, and trying to do so is a losing game. What you can do is look at the historical averages. If the Dow is down 10 to 12% and the RSI, or Relative Strength Index, shows that stocks are oversold on a weekly timeframe, you are statistically in a zone where long-term returns become very attractive. History shows that 1 year after a 10% correction, the market is higher over 70% of the time. The goal isn't to be right today, the goal is to be positioned correctly for 6 months from now. Don't let the 24-hour news cycle blind you to the decades of data that say this, too, shall pass. Now that we've looked at the history and the technical why behind the numbers, it is time to move into the most critical part of this video, the what now phase. Knowing we are in a correction is one thing, knowing how to position your capital so you don't end up a casualty of 2026 is another. This is where we move from theory into the actual 2026 correction playbook. The first rule of a 10% drop is to stop the bleeding of your emotional capital. Many investors make the mistake of panic selling at the exact moment they should be doing the opposite. If you sell now, you aren't saving your money, you are simply formalizing a loss that was previously only on paper. Instead of reacting to the red on your screen, you need to shift your mindset toward rebalancing. In a market like this, where oil is at $115 and tech is sliding, the great rotation is your best friend. This is the process of moving money out of overextended, high multiple growth stocks and into what I call the Dividend Fortress. A dividend fortress consists of companies with massive cash flows, low debt-to-equity ratios, and a history of increasing payouts even during recessions. In 2026, we are looking at sectors like consumer staples, healthcare, and specifically, large-cap energy producers. These companies are essentially paying you to wait. While the Dow is searching for a bottom, these stocks are dropping consistent quarterly checks into your account. If the market stays flat or down for the next 6 months, that dividend yield becomes your primary source of total return. It turns a dead period into a productive one. But what if you are sitting on cash? This is where dry powder management comes into play. The biggest mistake people make in a correction is blowing their load too early. They see a 5% drop and put 100% of their cash back in, only to watch the market drop another 5%. The professional approach in 2026 is scaling in. You break your available cash into 4 or 5 tranches. You deploy the first 20% when the Dow hits the 10% correction mark. You deploy the next 20% if we hit 12%, and so on. This lowers your cost basis and ensures that even if you don't time the exact bottom, your average entry price is mathematically superior to someone who bought at the peak. We also have to talk about tax loss harvesting. This is a sophisticated move that can actually save you thousands of dollars when tax season 2027 rolls around. If you have stocks that are down significantly and you no longer believe in their long-term recovery, you can sell them to realize the loss. You then use that loss to offset your gains in other areas, or even offset your ordinary income. You can then take that remaining cash and immediately move it into a similar but different asset, like an ETF that tracks the same sector, to keep your market exposure while capturing the tax benefit. It's a way to make the market's bad news work for your bank account. Finally, let's talk about the hedge. In 2026, the traditional 60/40 portfolio of stocks and bonds is struggling because of the unique inflation environment. This is why we are seeing a massive resurgence in hard assets. Gold and silver have historically acted as the ultimate insurance policy when the Dow enters correction territory. If the dollar weakens because the Fed is forced to pause rate hikes to save the economy, precious metals tend to soar. Having even a 5 to 10% allocation in physical metals or mining ETFs provides a buffer that keeps your total portfolio value stable even when the SP 500 is in the gutter. The what now isn't about guessing the future, it's about preparing for multiple outcomes. If the market bounces tomorrow, your dividend fortress and scaling in strategy mean you're already participating in the recovery. If the market drops another 10% into a full-blown bear market, your cash reserves and hedges mean you aren't wiped out, you're actually looking for bargains. Discipline is the only thing that separates a professional investor from a gambler. In the next chapter, we're going to look at the specific tickers you need to have on your watch list to turn this crisis into a once-in-a-decade wealth-building event. We've covered the why, the historical data, and the defensive playbook. Now, it is time for the final verdict, the 2026 market outlook and the specific move you need to make to turn this correction into a fortune. If you've made it this far in the video, you are already ahead of 90% of retail investors because you are looking for a strategy, not an exit. The next 9 months are going to be some of the most volatile in recent history, but they also represent a generational wealth window if you know where the puck is going. As we look toward the second half of 2026, the recovery timeline is tied directly to two variables, the cooling of energy prices and the Federal Reserve's pivot. Right now, the market is pricing in a worst-case scenario for the West Asia conflict. But markets are forward-looking. The moment we see even a slight de-escalation or a stabilization of oil back toward $90, the relief rally will be violent. We are talking about a snapback that could reclaim 5 to 7% of the Dow's value in a single week. If you are sitting on the sidelines waiting for all-clear news, you will miss the biggest gain days of the year. History shows that the best days in the market almost always happen within 2 weeks of the worst days. So, what are the specific tickers to keep on your watch list right now? First, you need to watch the oversold tech leaders. Companies with fortress balance sheets that have been unfairly dragged down by the broad index slide. Look for tickers that have an RSI below 30 but still report double-digit earnings growth. Second, watch the energy infrastructure plays. Even if oil prices stabilize, the demand for domestic energy security in 2026 is at an all-time high. These are the companies building the pipelines and LNG terminals that the world desperately needs. Finally, keep an eye on the volatility index, or the VIX. When the VIX spikes above 30 and then starts to curl downward, that is your mechanical signal that the panic has peaked. The contrarian mindset is your greatest asset in a 10% drop. Remember, a correction is simply a sale on the world's greatest companies. If your favorite store offered a 10% discount on everything today, you would be lining up at the door. Yet, when the stock market offers a 10% discount, most people run away. This is the psychological barrier you must break. The millionaires of 2030 are being made right now, in March 2026, by people who have the courage to buy when the headlines are screaming about a crash. My final verdict for the rest of the year is this: we are likely to see a sideways grind for the next few weeks as the market digests the new inflation data. Do not expect a straight line back to all-time highs. Use this time to trim the fat from your portfolio, get rid of the speculative meme stocks that have no earnings, and consolidate your capital into quality. Whether it's a broad S&P 500 index fund or specific high-conviction stocks, the goal is to be fully positioned before the Fed makes its first dovish comment. Before we wrap up, I want to ask you a question. Are you buying this dip, or are you holding cash and waiting for more clarity? There is no wrong answer, but having a plan is mandatory. Drop your thoughts in the comments below. I try to respond to as many as possible to help us navigate this volatility together. If you found this 4-part breakdown helpful, make sure to hit the like button and subscribe with notifications turned on. In this market, information moves fast, and being late by even 24 hours can cost you thousands. Stay disciplined, keep your emotions in check, and remember, fortunes are made in corrections, but they are collected in bull markets. I'll see you in the next video as we track the Dow's recovery toward the end of the year. The bottom is coming, make sure you're ready to catch it.